Okay, welcome. You're probably here because, well, you want to get smarter about your financial future, especially retirement, right?
Absolutely. Time is valuable. Knowledge is key.
So, let's get straight to it. Today, we're doing a deep dive into the Reliance Accumulator 10 Index Annuity.
Mm-hmm.
We're using info provided by Diversified Insurance Brokers, and our mission, really, is just to unpack its main features.
Yeah, understand what it brings to the table for retirement savings without getting totally bogged down in jargon.
Exactly. So this thing, it's called a single premium deferred fixed index annuity.
Okay, quite a mouthful. What does that actually mean in simple terms?
Think of it like a long-term savings vehicle
Yeah.
designed for retirement. You put in a lump sum, that's the single premium part.
Right. Deferred means you let it grow for a while.
Precisely. And the fixed index bit is where it gets interesting. It mixes potential growth tied to a market index, like the S&P 500,
Uh-huh.
with features aimed at protecting your initial money. Principal protection.
Okay, so that's the core idea. Potential market-linked upside, but with a safety net.
Well,
How does that actually work? How does it link to the market?
good question. So, you've got choices for where your money goes. There's a straightforward fixed interest option. Pretty simple.
Just earns a set rate.
Yeah. But then there are these 5 index interest strategies. They specifically mention ones linked to the S&P 500 and something called the S&P MARC 5% ER index.
Right. And you don't actually invest in the index, do you?
No, exactly. Your potential earnings are just based on how that index performs using different calculation methods.
The crediting methods. Like
Yeah. There's an annual point-to-point with a cap. So they look at the index once a year, but there's a ceiling on your gain.
Okay, a cap limits the upside.
Right. Or there might be a participation rate. You get a percentage of the index's gain. Or maybe a spread rate where they subtract a percentage from the gain.
Uh-huh.
And they even mention a monthly average method. The key thing is these rates, caps, spreads, they're guaranteed for the first year.
Only the first year.
Well, guaranteed for the first year, then they reset annually. But, and this is important, there are guaranteed minimums set in the contract. So they can't just drop to 0 after year 1.
Got it. So some predictability, but also some variability year to year based on what the insurance company sets. Now, what about getting your money out? Liquidity is always a big concern.
Huge point. Okay, so penalty-free access. In year 1, you can take out up to 10% of your initial premium.
10%.
After year 1, it's 10% of whatever the annuity's value is at that time each year.
Okay, that's pretty standard for annuities. Any other ways to access funds if something serious happens?
Yes, actually. There are a couple of waivers. A terminal illness benefit and a qualified nursing home waiver.
How do those work?
Basically, if you meet the conditions like a terminal diagnosis or needing nursing home care for 90-plus days and you were 74 or younger when you bought the policy,
Right.
you might be able to withdraw up to 25% of the value each year without surrender charges applying.
That could be really helpful in a tough situation. But if you need more than that 10% normally or don't qualify for a waiver, there are penalties.
Yes, within the first 10 years. Those are the surrender charges. They start at 10% in the first year if you take out more than the free amount.
Ouch.
Yeah, but they decline each year.
Right.
Down to 0 after year 10. It really underscores that this is intended as a long-haul product.
Makes sense. Okay, let's circle back to that protection piece. How solid is the guarantee on your principal?
So it has what's called a guaranteed minimum value. The contract promises your value won't fall below a certain floor.
And that floor is?
It's the greater of 2 things. Either 100% of the premium you paid in, minus any withdrawals or charges, of course.
Okay, your original money back, less anything you took out.
Or 87.5% of your premium accumulated at a specific minimum interest rate. They call it the non-forfeiture rate. Whichever of those calculations is higher, that's your minimum guarantee.
So there's definite downside protection built in. That's a major selling point for annuities.
Absolutely. Peace of mind aspect. Now, what about when the owner passes away? The death benefit.
Right. The death benefit is paid to your named beneficiaries. It'll be the greater of the annuity's current value or that minimum contract value we just talked about.
So it's directly to them.
Typically, yes. Which usually means it avoids the whole probate process, which can save time and hassle for the beneficiaries.
Good to know. Any quick logistical details? Minimum investment? Age limits?
Yeah, the minimum premium they mentioned is $20,000 to get started.
Okay.
And issue ages are from 0 up to 80, though the maximum amount you can put in might depend on your specific age.
Right. Insurers often have limits there.
Yeah.
Okay, so let's zoom out. If we were to summarize the overall value proposition here.
I'd say it positions itself as offering that blend.
Yeah.
Strong downside protection with that guaranteed minimum value.
Yeah.
Potential for accumulation, linked to market indexes, though capped or limited in various ways.
Yeah.
And some flexibility for accessing funds, especially with those waivers, though it's clearly designed for long-term money.
So it kind of aims to hit that sweet spot for people who want growth, but are maybe a bit nervous about market volatility impacting their retirement funds.
Exactly. It's about managing risk while still trying to grow the nest egg over time.
So for everyone listening, hopefully this deep dive gives you a much clearer picture of what the Reliance Accumulator 10 is about based on the info from Diversified Insurance Brokers.
Yeah, it's a solid starting point for you to see if this kind of tool might fit into your own personal retirement planning puzzle.
Definitely provides a foundation for more research or discussion with a financial professional.
hmm It's all about understanding the options out there.
And that leads us to a final thought to leave you with. Considering this blend, we've discussed the market-linked potential on one hand and the principal protection on the other. What role could an instrument like this potentially play within the diverse landscape of your long-term financial